A few weeks ago, I posted a series of charts on my blog that were under the general guise of looking at how an edge can degrade. The mechanism by which we define that an edge has degraded is by looking at returns. This led me to the wider question of what is the impact of the way we assemble returns, and how does that make the amount of money we generate change over time? The chart in question that kicked off my thinking was this one. It's a comparison of Berkshire Hathaway, Warren Buffett's investment vehicle, versus the S&P 500, in this case represented by SPY, which is an S&P 500 ETF. As you can see, for the past 2 decades, Berkshire Hathaway has struggled to match and outperform the S&P 500. It is not generating what we would call useful alpha. This led me to perhaps a broader and somewhat more esoteric question as to how do the early returns we generate and the order of those returns we generate in our account make a difference to the actual amount of money we make. So I thought I would meander through the notion of returns and how they're calculated and how we can play around with them to get different results. The first thing I want to look at and perhaps just comment on is this notion of annualized returns. This is a snip from Morningstar, the fund's rating agency, and you can see I've got a highlight box there. And I've highlighted 1-year annualized, 3-year annualized, 5-year annualized, and 10-year annualized. I have a problem with annualized returns. My problem is this. You're taking a single data point and then assuming that that data will hold out into a continuum of return periods. Think of it this way. Imagine I have a trading fund and in January it generates a 10% return. In very simple, harsh terms, I could say that my fund generates 120% return annualized. I've made 10% through 12 months in the year. 10 by 12 is 120. Annualized returns are a scam, but unfortunately people make very important investment decisions based upon them without actually understanding the ramifications of what they're doing or the drawbacks in the metric they are using to make this decision. Unfortunately, they are a mechanism used continually by financial planners. If there were to be a sub-theme to this little rant, it is be aware of the return you are being presented with. Think about it. Ask, is it annualized? But more importantly, don't just ask whether it's annualized. Say, can you produce me an equity curve of what the fund looks like? Because as we will see, equity curves tell you far more and a far more honest picture than do simply looking at annualized returns. Let me give you another example of how this plays out. Let's assume I run a fund, and in year 1 I make 100%. In year 2, I lose 50%. In simple terms, I could put in my marketing material that my fund returns 25% per annum, because it does. 100 minus 50 divided by 2 is 25. And if I asked someone the question, let's assume that you invest $100,000 in this fund, how much do you have at the end of year 2? Those who are good with financial calculators would probably come up with a figure that looks something like this. And you would think you've done very well. The unfortunate thing is that's an illusion. This is the reality of what happens. In year 1, you invest $100,000. At the end of year 1, you have $200,000. At the end of year 2, you have $100,000. But the average rate of return is 25%. The structure of returns with real money makes a difference. An extension of that point is that the order of returns makes a difference. And this is a very important difference, and it's one that's not understood. To explore this, I want to look at 64 years of returns on the Dow Jones. If I plot the yearly returns as a histogram, I get this. This would be familiar to everyone. You see variations of this around the place for various indices. Smattering of positive years, smattering of negative years, market always recovers. Unfortunately, this is used as an excuse by financial planners and stockbrokers to say, the market always goes up, therefore you will do well. And unfortunately, I see people who should know better continue to produce this myth. Indices are an example of survivor bias in action. Indices are designed to continually go up because they are culled of poor performing stocks. If I take these returns and convert them to an equity curve that is simply based on the value of $1 invested when we start, it looks like this. You can see this progression up over time, and you would expect that because it's mimicking the underlying index. This is the underlying index, except normalised for the value of $1 invested. If I break my returns down into two separate columns, I get this. There's too many to put in a single little example of this, so I split them in two, so you get a sense of what you are seeing. And you'll see they ebb and they flow, and they have a certain order. You can see 1960 was down 9%, 61 was up 19, 62 down 11, then up 17, up 15, up 11, down 19, down 15. You might not think this matters, but it actually does. The order of returns makes a difference, which is why when we do systems testing on a given trading system, we effectively take all the cards up in the air, throw them up in the air, shuffle them, put them back together, lay them out, and see whether we get something vaguely similar to what we originally got. Remember, these returns generate this curve. They're idiosyncratic to that curve. If I take these values and begin to reorder them in some way, so I introduce a form of randomisation, we can see what happens. So what I've done is I've taken a small segment so you get an idea. I've taken a small segment because initially to start with it's easier to manage, but it also shows us something absurd. So you can see I've got 4 columns. I've got our base return. This is just the return you would get from investing in the index. I then took the returns we saw earlier and I sorted them smallest to largest. So for the period 1960 to 1985, I took those returns out and I simply ranked them. So the smallest ones came first. I've then done the reverse so that the largest ones come first. I've then asked Excel to randomise the data completely. So we get a different spin on things. When I plot these as an equity curve, I get this somewhat absurd looking thing. You would expect that the largest to smallest in this early part of the sample would perform like this, because all the very high returns occur at the beginning, so you're compounding on very high returns. You would expect smallest to largest to be meandering along the bottom. The base is simply the control, and randomised to a degree looks a lot like the base. If I plot them for the entire 64 years, I get this. So if I'd stopped this trading system, let's assume this was a trading system, and I'd stopped it in 2007, I would be regarded as a genius. But all that's happened is luck has enabled me to have my largest returns come first. If I had been unlucky and my smallest returns came first, I would have the return of the blue line. If I just invested in the index, I would have the red. So you can see that changing the order, even though the example is absurd, makes a dramatic difference to what you get in terms of what your equity curve looks like. The order of returns matters, but there are some other things that matter as well. So what I've done here is I'm going to concentrate on doing 2 things. You can see here I've highlighted the year 1974. That's one of the years I'm going to alter, and I'll explain the alteration in a moment. In my second little test, you can see I've highlighted the year 1960, and this is the year I'm going to alter because that will also demonstrate something to me. So I've got three conditions. I have our base or control, just the returns from the index. I'm going to change 1974 from being down 28% to 0%. So it goes neutral. That big loss is eliminated. Post that date, this particular system will get the market return. So it reverts to the base return. So up until 74, base return. Post 74, base return with only the alteration of that year. 1960 is a little bit different. I'm going to change that year from being down 9% to up 200%. It will then underperform the market by 10% every year after that. So it has a single year where it does better than the market by quite a margin. For the remaining 63 years, it underperforms the market, so that when the market goes up, it underperforms going up. When the market goes down, it goes down more. Something interesting happens. You can see that eliminating the single large loss 14 years into the trading system has a greater effect on the account than putting in a single large win at the beginning. This is because of the very harsh feature of financial mathematics that says a 10% loss cannot be made up by a 10% gain on the remaining capital. It is very difficult to recoup your losses. And in terms of trading mantras, this is why we talk about cutting our losses so they don't get ahead of us. If I were to map the percentage return required to recover from a given loss, it represents an exponential curve. You can't catch it. What is interesting too is that even having a large year at the beginning of our test only just outperforms the base return. And that is because of the underperformance issue. We had a year of outperformance and underperformance. You might think this sort of test is somewhat absurd, but over the years I've had many an individual come to me and say, look, I've just made 150% on my trading account for this year. I believe I should manage money for others. And my response is, come back when you have the trading history. And they go, but I do have a trading history. I've made 150% this year. You might think that sort of silliness is reserved for retail investors, but it's not. Because many a hedge fund manager, whilst working for somebody else, has fluked, and I will use the term correctly, fluked, because they only did it once, had an outsized year. They've then gone out, raised money for themselves to start their own firm, and they've blown up. But there is something more interesting in the result. If we look at the value of $1 invested, we can see our base return. Our base return is $59.97. Our base return with the 1974 year taken out, and that rendered neutral, is $82.81, a significant degree of outperformance. The underperform the market by 10% with a single winning year in 1960 only generates 60.18. You might not think much of that, but consider, in the light of our earlier example of the fund that purportedly made 25% per annum, but which left investors no better off at the end than the beginning. It would be quite fair under very simplistic conditions for me to have a fund that only had a single powerful winning year and then underperform the market for the remaining 63 years to say, well, I really should be managing money because I have outperformed the market. And you can see this here in terms of our average return. The base return is 7.6% for those 64 years. It's 9% for the underperforming fund. This hints at the profound disconnect between the reality of an equity curve that looks like this and the illusion that is percentage return as given by this. This fundamental disconnect, unfortunately, is very difficult for people to see. It's even more difficult for them to access. because it requires you to get access to broken down returns for the fund over time and then calculating them yourself. But it also brings me back to perhaps a wider, more real world application. There is no doubt that in his early years, Warren Buffett generated exceptional returns. But that case has disappeared, and actually disappeared many, many decades ago. What's occurring here is a flow-on or carry-forward effect of having this notion of a single large return or series of returns early in your career. Because as we've seen, it is quite possible to have a fund that underperforms in 63 out of 64 years, yet you can still generate a return that, even though in this case it's only just above that of the market by a small margin, you can say, well, my average percentage return is reasonably higher than the market's, therefore I generate significant alpha. Therefore I have a valid reason for managing money for other people. What is missing from this is the notion that that fund underperformed the market in 63 out of 64 years. This gives you an idea of how distorted returns can be based upon a single event. So when you're looking at returns, even when you're looking at your own account, you have to be aware of the distorting effect of individual returns. You have to take those out of your portfolio management system and your returns analysis and see what your returns would be if you played around with those, if you let them drift down, if you let them drift up. That gives you an indication of how you're actually performing, but more importantly, it gives you a sense of how robust over time your system will be.